Record. Got it. So everyone hears this now? Like it has to be warned verbally, I guess.
I'm excited tonight. Thanks for hanging out, Nico and Yosef and Sandhya. Man, she's just an amazing lady. She's going to drop some big time nuggets.
Yay, Kristen.
Thank
All
you.
right, all
I'm your
right.
cheerleader.
Everyone, so this is one of my favorite time. I'm gonna take a nice, great screenshot of you guys smiling big and thumbs up. All right, show me your thumbs. Michelle, Jennifer, Janelle, if you can. If not, that's fine. 3, 2, 1. Nice. Vian, you had another guest there.
Yes, she's learning. I gotta start young.
Good.
Get her through that underwriting.
That's Christine.
Hey, Lori. All right, Nico. Who do we have tonight as a guest?
All right, so we have Sandhya tonight, guys. She is experienced in all aspects of multifamily, including underwriting, analysis, and raising capital to close syndication deals without delays. She's successful at asset management of Northridge Court Apartments, purchased for $6.75 million in August 2019 and listed for sale at $11.5 million whisper price in less than 2 years. She worked for 12 plus years at Texas Instruments, Dallas, managing $80 million in projects with budgets in excess of $28 million. She's got a huge list of REO, which we will probably get into some of it. But I also wanted to point out, there's a lot of stuff here that you guys are going to enjoy, but I wanted to point out that she is a limited partner on 17 multifamily properties, totaling over 4,000 doors aside from her GP share in all these other doors, 500 plus doors. So welcome, Sandhya.
Thank you. It's great to be here. And I think I was trying to reach David a little bit earlier because I'm going to talk about a deal that we both did back in August of 2019. I think he's one of the loan guarantors for that deal for which I'm a GP. And we're getting ready to go full cycle on it. It's getting listed in the market. And right now we've got a BOV for 11.5. And I think it's going to trade for more than that. So all our investors will be doubling their money in less than 2 years, which is exciting. So, you know, of course, the market helped, the cap rate compression helped a lot, but I think there's also some asset management to be done here. So thank you for the intro. Thank you for having me here. I do have some slides to present, but if it gets boring and tedious, you know, interrupt me, stop me with a joke or stop me with a question as the case may be. And I will go from there. I'm going to try to share screen if I have permission. Hopefully I do. Let's see, here I am.
You should have it. And if you have any questions, please type in the chat box as we go, or in the end, it will be addressed, all of them.
Yeah, also, guys, a lot of people put their information. If you want to put your information in the chat box, that's helpful as well, so that people can reach out to you if they're interested in reaching out to you. So put like your email or something, your name and your email, that would be nice too.
Yeah, and then I think if you see the 3 dots to the right of it, you can save the chat, and that way you'll have everybody's contact info. So that's always nice. That's part of the networking, right? If you were in person, you'd be exchanging business cards. So basically the same thing.
Yes, and we'll also email the entire chat history to every attendees anyway, so it's good.
So we're here to talk about investing in apartments, and by that I don't mean duplex and quadplex. I'm thinking closer to 100 doors, 80 plus doors at a minimum, so that you can have the economies of scale and have third-party property management to run it. So that's the kind of deals I do. That's a very narrow, I guess, focus I have. So my background, I've had a career in engineering, and I've also got an MBA. So I played around with the stock market for over 2 decades. And I ended up paying a lot of money in taxes. And that's what led me to multifamily, in the sense I wanted to get into real estate, but I didn't grow up being a handy person. I was your typical Asian geek, you know, I made good grades. I went to engineering school kind of person. So I really don't know how to fix up a house. So I didn't want to get into any single family rentals where I'd be called to fix a toilet leak in the middle of the, Thanksgiving break or something. So I stayed away from it. But then when a friend told me about multifamily and the fact that you could have hired a third-party property management company to do all the work for you, and you can still afford it because the economies of scale allow that, then it made sense. So I'm like at, I think 4,000 plus doors and over 500 doors now as a GP. And then, yeah, LP is most of it. But I've got about 4 deals now as a GP and then passive in like 17 deals. So I got to update the slide a little bit. And one of the first things I always say is, everything here is totally my opinion, and I have a lot of opinions. So, I'm not here to give you any kind of CPA, accounting, legal advice, etc. And a lot of these scenarios may not apply to you. And there is no solicitation here. And you want to be very careful when you invest. You want to really invest only with people you know, like, and trust. I know there's a lot of 506c offerings out there, so you don't really have to know people. You can be referred by a friend of a friend, but I always encourage you to do your own due diligence. I mean, how much time do you spend before you decide to buy an appliance or a car, right? And this kind of investment is even bigger than that. So you should at least do that much of due diligence on people as well as the deal and the markets. And yes, any investment carries risk with it. You could lose 100% of your investment. It's unlikely, but it's very possible. So be very careful. So that's one of my many free advice things for the day. And so for me, I like to make money while I sleep. That's my inspiration, is Warren Buffett. So that's actually passive investing, which is why I have so many deals passively. But then I also have a few deals active to where it doesn't take over my life like my corporate career did, but it's still enough excitement and fun and, some challenges along the way, right? But it doesn't overwhelm me. So for me, about 2 to 3 active deals is the most I'll handle, because I acquired one deal in December. Now it's somewhat stabilized. Now I'm ready for the next deal kind of scenario. Now, a lot of people are different. They do a new deal every month, but those tend to be more of capital raisers, because if you're going to also asset manage 6 deals in a month, yes, with a vertically integrated company, etc., it carries with it its own risks and demands. So those people don't get much sleep. So what's a real estate syndication? Just to make sure we're all on the same page. I would love to go buy a $10 million apartment by myself, but I can't. So I need a $3 million to put as a down payment, and $7 million will be financed. So all the people who helped me contribute towards this $3 million, those are limited partners or passive investors. That's what I did in 17 deals, as I helped with that. And I don't get to make any decisions if I'm a passive investor. It's like I'm a passenger on a flight. Once I decide my route and I buy my ticket, I sit back and enjoy the ride and listen to the reports periodically, right? It's the same thing, versus a GP is the one who's buying the deal and making all the decisions, hopefully good decisions to make money for me. And they are the ones who execute the business plan and follow through and make sure the money is used wisely. And then somewhere in between, there's this key principal or loan guarantor who usually has the liquidity and net worth for the loan signing. Because on a $10 million deal, let's say you're taking a $7 million loan, the net worth of everyone who's signing the loan has to amount to at least that $7 million. And that's where a key principal comes in. And they're also more like an LP from a decision point of view. They don't get to make decisions on the deals. They just along for the ride like a passive investor, unless the GPs really screw up or for any reason die or something, and then the KP takes over, but that's pretty rare. So that's a role of a guarantor or a key principal. And passive investing, hey, money is working for you and you're not trading your time for money, right? Like a W-2 job. You show up to work, you get paid. You don't show up to work, you probably don't get paid after some time. I mean, they may give you a week off, but after that, you still have to come back and do the work, right? So passive income is your mailbox money that you make while you sleep or sitting on the beach, as the case may be. That's the ultimate goal, right? Money comes pouring in whether you work or not. So apartments versus single family, I think most of us know why we do apartments over single family, but just in case, your value is based on the NOI, net operating income of the property, which is revenue minus expenses. So keep increasing the revenue, whether that's by increasing rents or other income, and keep reducing your expenses so that the difference is your NOI, net operating income. And the value of an apartment is based on its NOI divided by the cap rate. Single family, the value is based on the price per square foot in that particular neighborhood or that market. And that's kind of set. And you may get a little bit extra. Okay, you have a pool or you're back to some beautiful creek or you have an oversized lot. There's some extras for it, but otherwise your value is kind of fixed. And single family, when one tenant doesn't pay your rent, you lose 100% of your revenue. Multifamily, you account for it in terms of economic vacancy. And so that's how you make it work. Any questions on that? Feel free to interrupt me because I'm assuming most of the audience knows this, but if I'm going too fast, tell me to stop. And so I
You're
love
doing
to
great.
avoid the tenants, toilets, and trash. So that's what I have in the bottom is, you avoid the 3 T's when you do multifamily because you have a third-party property management company running it for you. The other big one is when you buy single-family homes, you're signing usually recourse debt with a bank loan versus multifamily. I've probably signed enough loans to amount to over $50 million, and that's way more than all of my net worth, right? But that's why signing a $20 million loan doesn't stop you from signing another $20 million loan. And that's the beauty of non-recourse debt. So these are some of the reasons why I chose multifamily. It made a lot of sense. I completely skipped the single family route. So I went from engineering job and stock market into multifamily. So stock market benefits, liquid assets, but you don't have any visibility to the decisions being made. You hope Jeff Bezos makes good decisions or whoever's running Amazon now kind of thing. So, right? And you hope your stock goes up in value. It's pretty volatile. So I still love the stock market, and it's very, very liquid, which is nice. But at the same time, there's people who don't like it. And so they balance their portfolio by having some of it in real estate. And within real estate, I'm partial to multifamily because as we saw last year with COVID, a lot of other businesses suffered, but multifamily held on pretty steady. And I saw that in my own properties, the ones I asset manage as well as the ones I'm passively invested. Maybe some of the distribution stopped a little bit, but it was excellent. It was much more steady. I remember that one day last March when all the stocks plunged a significant amount, my multifamily didn't suffer a similar volatility on that day. So, if you're carefully vet the deals as well as the sponsors, I think it makes better risk-adjusted returns. But again, I do both for that reason. I like both. I enjoy both. So again, figure out what your goals are and what's your risk tolerance. And that pretty much will lead you to making the right investment. And I think that I can't stress this enough. Do as much homework as you can on the people as well as the market. Don't believe what's in social media. No one's going to say, I did horribly in my last deal. I lost all my investors' money. No one's going to say that on social media. But if you ask them for a list of their deals, then you can say, give me a passive investor in each of these deals you've done before, and then go and ask the passive investor, how did this particular deal perform? Did they make distributions last year during COVID? Or did they just give your money back because the market, cap rates compressed, so the property made money anyway and they returned your money to you? Or were they actually successfully asset managing through COVID? How were their delinquencies, right? So peel a few more layers before you part with your hard-earned money. Or you partner with someone who sounds perfect on social media, but in reality is out to make money with all of their fee structure. So look closely at the fee structure in deals. Acquisition fee, disposition fee, refinance fee, everything is a fee. Guess what? You just pay me for breathing kind of fees, right? So watch out for that. Construction management fee, 10%. So let's say there's a CapEx project and it's going to cost $500,000. They get $50K just for managing a CapEx project, right? So watch out for hidden fees like that in deals. Vetting a sponsorship team, again, it's the track record that's the most important. Another thing is, a lot of people love to do remote control because they say, oh, there's data. Atlanta is a great market, but I happen to live, I don't know, in the West Coast or the East Coast. Well, if there's no boots on the ground, no matter how much you look at data and numbers, what's actually happening at the property could be a very different story, even with cameras and monitoring. So given if 2 deals are equal in terms of everything else, I'll pick the one that has a sponsor that's local to the property, local to the market, and has prior experience in that same market. These are, again, a few more questions I have on vetting a sponsorship team, and I can share these slides with you. I don't want to go too much into detail other than the skin in the game is very important to me. There's a lot of sponsors who advertise saying, hey, I put skin in the game. I've got 100,000 of my own money invested in this deal. Well, then they take an acquisition fee of the same 100,000 back. So then they really don't have any money in the deal, right? Once the deal closes, you, the passive investor, have money in the deal. They don't really have any money in the deal. So another thing that I look for, because again, I invest so many deals passively. So why do I invest passively when I can easily syndicate my own deals and make more money than the passive side? Because you are trading your time for money. Just like a W-2 job, asset management is a job that takes time. Or even capital raising is a job that takes time, right? So syndication requires doing active work. As an LP or a passive investor, doing that first gave me so much knowledge and insights. A lot of the deals I invested as an LP like 2-3 years ago, they're all coming to a full cycle now. So I have 2 to 3 years of actual data from my monthly reports, and I already have a relationship with the seller. So if one of those deals is really good, I have the connection to probably buy it. So that's very helpful. I am networked with at least 17 different sponsors from my passive deals, and many of them are in my target market. So I already know what works and what doesn't in my target market as far as strategies, right? And I can physically visit these properties. I pick a lot of them near me because I live in Dallas. So I can visit these properties. I can see how these projects are done. So it's like what I call the practical training or the hands-on learning if you want to get into the asset management side. But let's say you only want to stay on the capital raise side and you have no idea about asset management. You might be able to spin a story the first time and convince some people. You might be really good at marketing. But after a while, if you don't have strong asset managers running your properties, it's going to catch up. So that's sort of my caution is when people don't know anything about asset management, it's harder to spin that story over and over to the same group of investors. That's my opinion. So what are some key metrics I look for when I analyze a deal, right? It depends on cash flow, preferred returns, overall return, etc., right? So if it's retirement funds, you may not care what the cash flow is in the short term, but in 5 or 6 years when it closes, I want the really big upside. And then what is the split? Why do you care about the split? As long as it's your return, who cares if it's 80-20 or 70-30, right? Well, what if they don't come through? I'd rather reward them in this case in the back end for doing a good job and meeting certain hurdles than all of it as an acquisition fee up front. Like you imagine a 3% acquisition fee on a $50K deal, $50 million deal, that's $1.5 million. So something to remember. What else? Market, job growth, population growth, etc. So now I'm going to actually go into the asset management side and talk about one of my deals. So pardon me as I switch screens here to another presentation. So this deal is Northridge Court Apartments. So this was my deal from 2019. This was my very first purchase. It's 86 doors. As you can see, it's a flat roof. And this picture shows the side which has townhomes. And then the other side has apartments. So this is like a summary of the deal. We purchased it for $6.75 million. And we had a rehab budget of about $432K. And we only had an 86-14 split. So most of the money went to the limited partners or passive investors. So you always want to talk about the location, where it is with respect to any major employer sources like DFW Airport, downtown, etc. And why is this location good? What are some signs of economic growth and development, etc. So in our case, we specified some of that here that you can read in the bullets. And we were actually doing something that hadn't been done in that area. We decided to switch from RUBS or ratio utility billing service to all bills paid. We felt like the demographic there would appreciate knowing what their rent and all bills were every month, instead of having that variation month to month, depending on, the Texas summer with high air conditioning bills, or, the winters with the high gas bills, etc. So we were the only property to offer that. And that seemed to have worked because we're almost always 100% occupied. 97%, 98% is pretty typical. And
Sandhya, what is all bills paid?
So your utility bills, right? Electricity, water, gas, all of that. If you're renting the typical nice new apartment, usually you are responsible for paying all those bills. So instead of that, in this particular apartment, we, the landlord, said, we will pay all of the bills. So not just your rent, but all of your utilities.
And people like that.
That particular demographic loved it. They loved to know what their bill was going to be every month.
Yeah. And were you able to push rents a little higher because of that?
Yes, we were able to push rents for several different reasons. One of which was this is more for us to conserve on the water and the electricity by implementing an LED upgrade. That reduced our expenses. Remember, there's two ways to boost your net operating income. So one of them is to increase your rent by implementing various strategies. And the other one is to reduce your expenses. So I won't go too much into the market here. That's the location and why there's some economic drivers. But in terms of the asset, this is what it looked like. And you're looking at a picture of an upgraded unit here. So usually interior upgrades is a very common way to add to your rental income. When you go from an old looking unit that's never been updated before to nice interiors, usually you're able to achieve a $100 rent bump. Even your existing tenants would like to move from an older unit to a nice newer unit and pay the extra income, the rent bump. One of our other strategies was in this particular property is to add one more unit. The leasing office was housed in the largest unit that we had, a 2-bedroom, 1.5-bath townhome. So anytime you're able to get an extra unit, that's pure NOI boost. So you always want to try to do that. So that was one of our first projects. So we had a due diligence done. And so let me go into the business plan, right? So unit upgrades were always done. So whether that's black appliances, brushed nickel fixtures, etc., we had a list of things that qualifies as a unit upgrade that would give us a $100 rent bump. The other thing was just adding an extra unit by converting a portion of our laundry room into a leasing office so that this unit could be fully leased. And so that was about $1,200 a month in rent times 12. You're looking at $14,000 plus dollars. 14.4 in annual additional impact to NOI. And so that was a big one for us in terms of immediately boosting the NOI. Then when you conserve water and utilities and you are the one paying all the utility bills, then you are getting a very big reduction in your expenses by doing that. So that's why those two strategies combined resulted in a nice NOI boost. Another thing we did on the townhouse side that you can see in this picture is we added privacy fences like backyards. So now people with little kids and pets can just let them out there and it's nice and private. And of course, a lot of people like to put their barbecue grills, etc., over there. So it made it seem more like a single family home rather than an apartment or a townhouse. And then we do little contests every month for pets. We say, okay, post your, cool and cutest looking pet on our website and we'll have a drawing. And what that does is sometimes people forget to tell us about their pets and we figure out, oh, there's like 10 more pets in this apartment. And that's right there, a direct boost to your NOI because pet rent, there's a deposit and there's a rent. And that just gets you an immediate impact to your NOI. So if you want to increase your net operating income on a property, you look for ways that tenants will pay for increasing rent and other income. So a popular thing we're doing nowadays is the Wi-Fi package. So streaming Netflix is something everyone does, no matter how rich or poor you think they are. Wi-Fi is now not a luxury, but a necessity. So if you can pay the CapEx dollars, which is capital expenses, right? Because when you have a capital expense budget, like I'm going to go do these fences, or I'm going to go install Wi-Fi equipment, that money that you raise to do that, or you finance to do that, does not impact your net operating income because it's a one-time expense. It's not an operational expense. So you can implement Wi-Fi package. Like we spent $10,000 and got the stuff installed in our property. And now we are offering the same Wi-Fi that Spectrum offers, the same internet speeds for about $20 less than what the tenant would pay Spectrum directly. So a lot of them sign up for that service right away. And so that's, again, additional income. That's a pure NOI boost. Our break-even occupancy, no, our break-even point for that Wi-Fi package is getting 8 tenants signed up. So when you have 100 doors, 86 doors, 200 doors, getting 8 tenants signed up for your Wi-Fi, which you're offering at a lower price, is pretty easy to do. So anything else after that is pure profit. And the way we promote it is on all new leases, we give them a free first month of Wi-Fi. So when you're moving in, there's one less thing for you to worry about. We'll give you free Wi-Fi. And then they like it. They know it's cheaper than what's out there. So they just sign up for it. And then, you know, it's a direct impact to our NOI.
Cindy, I'm sorry. So when you introduce the Wi-Fi plan to the new commerce, did you have like a comparing sheets between Spectrum and other services with your Wi-Fi?
Yeah, our leasing manager has that, and she's incentivized to promote certain number of Wi-Fi signups every month. So she gets a little boost also. And then all new leases, we try to get that in. But our goal in the property we're acquiring now is in a year's time that it's part of it package. So that we position ourselves instead of as a B class property, more like a B plus to A minus property, where you've got laundry, you've got Wi-Fi, you've got everything included. This is more of a premium property within that area. So come to us where everything is included in your convenience right there. So A class property at a B class price is sort of our positioning. But yes, that's an easy way. Another thing you can do even with existing leases is you can offer it as a promotion. Again, you can say, come and add on Wi-Fi. It's an extra charge, just like you pay extra for parking or something else. Come in and do Wi-Fi. And
I think I think it's a great point that, you know, you're not just boosting the NOI by raising the rent. You're actually offering something in value for the tenant in return, so that it's not just you're actually raising the rent for no reason, right? You're actually giving them some values, and in return you can raise the rent so that the tenant should be happy.
The other big reason the tenants are happy with this is that it's already in their budget, in their household budget. So you're not stretching their dollars by asking them to spend more money on something that they don't really need, like maybe a fancy looking kitchen. I don't know how much they care about that for $100 more, but something like Wi-Fi, something like laundry machines, that's part of their household budget and spending every month. So you're actually offering it to them at about the same price or a little bit less. That's really very popular. So we've had no trouble with getting adoption on one of our properties, and we're planning to do the same thing in the second property. Now, a lot of brokers advertise the properties as, oh, add washer dryer connections and you'll get this much of a boost. The problem is when you actually dig into the asset management side, you realize, oh, for me to have a washer and a dryer here, I need to make sure there's a place for me to vent the dryer, right? Do I have to drill through bricks for it? Can the electrical panels support the wattage and the requirements of having a washer there? What about my plumbing, right? Upstairs unit versus downstairs unit, you know, there's a lot of challenges. So just because you read a broker's OM and they tell you can add washer dryer connections, when you investigate it, it's going to cost you a lot more. So make sure when you tour properties to take someone along with you, a contractor, who can actually look at the unit types and say, oh, it's going to cost you this much, plus you got to get permits. You may have to add another breaker box and new panel, etc. So don't forget those considerations. So you can do the washer dryer additions for a $50 rent bump, but the cost to do the connections and then rent the washer dryer is going to be, you know, $4,000 per door. It may not make sense, right? You have to look at your payback period and the ROI when you implement any kind of a CapEx plan to see what it does to boost your NOI and whether or not that demographic and that market can support it, right? So that's important to keep in mind. Now, I mentioned parking earlier. Some places may have ample parking, and so it may not be such a big deal to implement parking as a reserved or covered parking. So we always do that as an extra thing later we don't bet on it upfront in our underwriting unless it's a proven concept. Now, if a property already started implementing reserved and covered parking and it's a steady part of their other income every month, do you really think there's room to grow that by an additional 20 or 30%, right? So I keep that in my back pocket as an idea, but until I take over the property, I do a survey of the tenants. Once they sign up, like at least 10 tenants sign up, then I got to get permits before I can do covered parking. Reserved parking is a lot easier because all it is a stripe. You just say, okay, this is spot number 66, belongs to, apartment C2, and I'm done. That's an easy one to do. But even those, if you want to promote that, always offer it free for the first month on new leases, or offer it as part of your, we have a new drawing for something, prizes every month on different things. So if a tenant reports a leak and we verify that it's an actual leak, we put them all into a drawing. Or if a tenant pays their rent on time every month, they get into a drawing in a jar, right? Their name, we draw them out of a hat. And some of the things we offer them are free reserved parking for a month or something like that. So once they get used to an idea and they like it and it's free, then they wouldn't mind paying for it. It's sort of like, you want to taste before you buy concept. So a lot of these strategies really work because especially reserved parking is one of the easiest ways. Pet rent, getting pet fees, have a contest, give them a nice PetMart gift basket, and they'll declare that, we have 10 extra pets in the apartment we never realized. And again, another good one, the reserved parking is a really good one. It's an easy one, doesn't cost you much. And Wi-Fi, right? Really investigate Wi-Fi. Make sure whichever vendor you pick for Wi-Fi in that area, that the Wi-Fi signal is really good and solid. And make sure they have the knowledge to make sure it is good in that building that's the farthest from wherever you install your equipment, right? Because otherwise you'll have very angry tenants. You'll have to give them free for several months. And, if it disrupts their work, that's not a good thing. So, until you get into the asset management details, you don't realize there's more to it than just what the broker writes in the OM.
True.
So I hope that gave you some ideas for asset management. So these are some of the costs associated with it. You always want to make sure you take a vendor who will actually do that project for you for that price before you just, put in your own budget. And always go 20% more in terms of conservative underwriting than what he gives you. So like new office budget was $12,000. We actually ended up spending more like $20,000 on that, right? So it depends on what cost you're including in that. Now, just the moving the walls and paint and all that, yes. But then we ended up having to buy furniture that fit the new office and decorated. So it all adds up is what I'm saying. Now, this is actually the underwriting and the pro forma. So I don't know if this is too much in detail for you guys. But this is the deal that we bought in August of 2019. And if you just look at this yellow part here, that's the returns where my arrow is. And a 5-year return that we had projected was about 70% in 5 years. Very conservative numbers. And I'm going to go to this next slide where I show you, here it's called a reversion cap or an exit cap. That's a prediction of what the cap rates will be when we sell this deal. And we put in there 7.4%. The higher the cap rate, the more conservative your underwriting is, the exit cap. You have a question?
What factors did you have when you decide the cap rate again? Because it's some people, I know some of the people who attended this meetup asked me before about this, and I want to lay this out for them.
So what we do is we look at the purchase cap rate. So this deal was purchased at a cap rate of about 6.5. And I recommend an exit cap rate to be at least 75 to 100 basis points above the entry cap rate. That makes it a very conservative underwriting. If your exit cap rate is equal to or less, then it's a very aggressive underwriting. So exit greater than entry cap. How do you find your cap? Well, your entry cap is the net operating income divided by the purchase price. That's the cap rate at which you're buying the deal. Mm-hmm. So you have an entry cap and you have an exit cap, and make sure the difference is at least 75 basis points or more. And we picked 7.4. But today the cap rates are well below 6, probably 5.5 for that area. So that's why we're getting such a good price for it. So this is the projections we had provided to investors at the beginning. And we said if you had invested 100,000 in 5 years, that would become 170K. Instead, the reality is the one who invested 100 with us 2 years ago is going to walk away with 200 in 2 years, rather than 170 in 5 years. So it's a surprise of the nice kind, you know, where they get more than what we had projected initially. So under promise, over deliver.
Over
And
deliver.
again, yeah. Did you have a comment?
No, go ahead. I'm gonna read some of the questions after you're done.
Okay, and then the fee disclosure. Always ask them for the fees. In this particular deal, it was my first deal. My sponsors had only done smaller deals, my other partners. So we did not charge any acquisition fee. We had an asset management fee. Our split was very much in favor of the investor over the sponsor. And it was a flat percentage. There was no waterfall structure. We had to pay the management fees to the management company. And we had also a buyer broker fee. And this is sort of like a graph that shows the projected annual cash on cash. We made a 20% distribution to investors in March. So this deal did way better than we had projected. And this shows you the reversion cap rate or exit cap rate sensitivity analysis. So at a 7.4% cap rate, it's a 70% return. And below 6, it's well over 100% cap return. And that's where you want to be. You want to be conservative in your projections and pleasantly surprise your passive investors so they keep coming back. So we sent the monthly newsletter announcing the sale of our property. We actually had so many people reply saying, oh, that's fantastic. Now find me another deal. I'm like, sure, no problem. We'll get it lined up by the time this one sells, kind of thing. So that's the kind of pleasant surprise you want to get. So yeah, you got some questions?
So first question was what I had. So how would you determine, sorry, that's not the question. How much of the underwriting CapEx projection or business plan did you actually perform after purchase? Do you think you can perform 100%? You perform 100%?
We did all of them. So we did the leasing office, we did the LED upgrades, we did the water conservation, we did the interior upgrades on most units. I think there's still 2 units or maybe 3 that are still classic. The same residents have stayed there, so we didn't have access to them. But otherwise, and so we still have a lot of money left still. I think we have about 80K or so left in our CapEx budget that we did not spend. So
what are you gonna do with that? Are you gonna?
It's part of the money we'll return to the investors, right?
Right, you're gonna return that.
Yeah, it's part of the returns, whatever money is left.
Okay.
So
great.
thank you.
Michael.
She answered. I saw it in the business plan. So my question was with the units that had with the fences. I didn't see until you put into the business plan. So I was going to ask, how much more did you charge for the fence? And it was, I believe, $30, correct?
We started out at 30, then we moved it to 50, and wow, people are willing to pay it. That, I don't know what is so unique about that property. We've increased rents on a total by about $350, and we're still heavily fully occupied. We're still 98% occupied. I have 1 vacant unit that's already pre-leased that we're waiting on my handyman to make ready the unit before somebody moves in.
If I could ask one more, with the parking, I saw it's 15 per space. Did that go up as well?
We actually didn't get too much of a buy-in to that parking. They felt like they were entitled to it. So we didn't really do it. We were able to do other things. But parking, again, like I said, when you enter the property, you go and do a survey. And then based on that, you take it. There was ample parking. There was a cul-de-sac there. So people just weren't willing to pay for it. And we'd rather just get it as a rent bump than worry about parking and monitoring it and then towing away somebody who didn't park in the right spot and all that. So,
thank you.
Sure.
Great. I think VN and Jay had the same question as to your 75 to 100 bibs, regardless.
Mm-hmm.
Okay. So is it regardless of how many years of holding, would you put 75 to 100 bibs for exit cap rate?
That's a conservative underwriting, because now you are having that little margin of error. You're having a little bit, like if you have another COVID kind of thing happen, or like in Texas, we had what we call a snowmageddon happen, and suddenly you have 20 units down because of flooding and pipes burst, then you have some leeway there. You have a little bit of cushion in your underwriting, because you would never want to underwrite anything. And having been a project manager for years, I can tell you this, things never go according to plan, right? So you never want to underwrite something to a scenario where everything goes perfectly, or at times are as good as it is right now. You want to underwrite it like it's getting worse, and it's more of a buyer's market than a seller's market. And that's where that cap rate comes into play. Because as soon as you compress the cap rate, your returns are going to go up in a big way. So don't bet on that happening.
So is that base point like a fraction number? So let's say your entry, okay, so
plus 0.75. Like if your entry cap rate is 5, then I put a exit cap of 5.75 or higher.
Okay, got it. Yeah. Okay, understand.
Thank you, Trevor.
Let's see, Jay, have a question?
Oh yeah, same question. Let me turn on video.
Sorry, I was thinking of a different Jay.
Yeah, sorry.
There's 2 Jays here.
Many Jays.
Yeah, sorry, I'm not sure. I joined late, so I'm not sure if that question was already answered. But my question was about mainly lessons learned from an asset management standpoint. Some of your like biggest unexpected moments that you came across. Would love to hear some experiences.
So I think one thing we all know, probably even from our home experiences and single family, if you've had that, is contractors say one thing, they don't always deliver, right? So you want to always get multiple bids. We always have contractors giving us estimates and then they go beyond. So read the actual contract. Don't read the marketing guy who presents the project to you. He'll say all the right things, yes, yes, yes. Make sure it's in the written contract that you formally sign with that company to do the job. And always hold back at least 10% till you do a full walkthrough. And as an owner, I always like to go with my local PM when a project is completed before the last payment is made. And we work on a checklist and say, okay, make sure this punch list is done before we pay you that last payment. That's one. Another thing, this particular property that I went into a little bit of detail on that David's familiar with, it's in a place called Cleburne, which is more of a tertiary market. So even though it's only 30 minutes from Fort Worth, a lot of contractors were reluctant to come that far. So you had to make sure you had enough money and enough hours of work for them to do. They wouldn't just come for a half-a-day job. And so that made it a little bit harder for us to get enough contractors. And so we had to pay a little bit more for some of them. And in terms of the things I think that we did the best was last year with COVID, we had already, one of my big favorite things to do is community activities. So every month I do something for my residents. So we did like a free Easter egg hunt, for example, and we did a free Thanksgiving turkey giveaway in November, the week before Thanksgiving. So because of that, we build communities and we give a referral bonus to tenants. We always remind them, if you have a friend or a family member who you think is a great fit for our property, bring them in and we'll give you something free. Because of that, when COVID hit, most of our residents already had a good relationship with the property manager. And so we set aside one day where, socially distanced, we had appointments made for every tenant who was behind in their rent payment, even by a few $100s. And they made appointments to sit out in the courtyard in the open air. And our leasing manager helped them fill out all the applications for rent relief. And most of them got approved. There was only one person who didn't get approved. And we got all the payments directly paid to us as landlords. So our delinquency, I think in January, was like less than $100. And most of them were back on their feet in 3 to 6 months. And we didn't lose a lot of money. So I think when you build a community and you get that relationship going, it's easier for them to come forward and not be shy about or hide from you and not pay rent. You don't get as much of those kind of problems, because I think if you have a plan to address delinquencies and you build communities, you're going to be successful. It's going to be a win-win for all.
That was awesome. Thank you, Sandhya. That was all 3 good points. Yeah, super helpful.
So yeah, I went a little bit into the asset management side, but if you have questions on the underwriting as well, I'm happy to answer that. I think for you to win deals, if that's your focus, I would say the biggest thing is to focus on just 1 or 2 markets, and sort of like, it's sort of like a horse racing, you know, stay in your lane. Don't worry about what others are doing. You just go the fastest you can in your lane at the speed that's right for you, and stay focused on your target. You know, you're going to see all kinds of crap on social media, and don't believe it. And don't believe what people say, because half of it is untrue, as you know. You know, you'll see people posting the happiest pictures of perfect looking families, and a week later you'll find out they're divorcing or something, you know. So it's just like that with social media and success stories. Don't believe a word of it. Verify it with someone who actually is involved in that deal, right? Who will actually tell you the truth of what's happening and all the disasters that really happen. So to get awarded deals, I found that the only time I got awarded deals is if I had a very strong relationship with a broker. It doesn't matter that I have the highest price. The relationship with the broker is what gets me deals every time. So if you're out there in whatever market it is, get to know who are all the top brokers and find a way to connect with them. Like, I'm not this, you know, cool looking fit dude in my 20s who goes and golfs with them and has beers with them and all of that, right? I'm this mama with kids and, you know, thinking like at a PTA level, and maybe it's a stock market. So I have to still find a way to connect to this 20-something-year-old dude out there. So, you know, you got to go do it. You got to put yourself out there, find a way to relate to them and connect with them. I don't care. Just find a way, right? So that's the only thing you can do to win deals. Because there are some brokers who control the market. Some places I think you might be successful getting off-market deals, but I'm talking about a big market like Dallas, Atlanta, places like that. So even if like I'm going to sell a deal, you know, I've got my deal listed for sale, I could have sold it to any number of people I know in the business, right, directly. Why do I list it for sale? Because ultimately, with all these bidding wars, it's a seller's market. I'm going to get the highest price by listing it with a famous name broker. They're going to market it correctly. I know how many hours they spent on my property marketing it just right, and how many questions we had to fill out, et cetera, to get it ready for sale. So they're going to make sure it's a bidding war. They're going to get me the highest price. And I care because what? I'm ultimately responsible for getting the top dollar back to my passive investors. So even though I know a lot of people, I'm going to list it to, and it's again a relationship business. So if that's the broker who awarded the deal to you in the first place, you kind of owe it to them to give them that business back. And that's how it works. But let's say there's 5 offers on the table in best and final, and I happen to know one of them, and they're all meeting that highest price. I'm going to favor that one person, right? As far as who I sell the property to. So your relationship and networking in the business, that's why I'm a passive investor in 17 deals. I know 4 of those deals are going to come up for sale in the next few months. I've already looked at them, and I know there's 2 of them that's worth pursuing. There's 2 that don't meet my criteria. I don't want to be in a certain location which has high crime. I know that sponsor can handle it, but I don't want to handle it, right? I don't want to be afraid to go to that property. You know, I don't want to solve crime issues. So I already know that. I already have a relationship with the seller. So if I want one of those 2 properties, all I have to do is what? Basically meet the price, right? Whatever is that highest price, I got to go say, please give me the last look, right? Give me the last look. Give me a chance to meet that price. Because the seller already knows me, I have a 2+ year relationship. I just need to make sure whoever they list with, the broker also favors me, and I can get one of those properties. So this is a relationship business for the long haul. So whoever is in your group, who's going to be in your partnership team, who's going to be chasing the deals, they need to be having lunch with brokers on a regular basis.
Great. That's great. I think 1 hour is too short for all the knowledge that Sandhya could deliver to us. It was great, presentation, Sandhya. I know it's already past 8. I just have one. If anybody has no question, JU, did you have any follow-up question? If not, I have one follow-up question. Sandhya, how and when would you start communicate to the property managers as to your business plan, and how would you make sure they're helping you to execute that?
So that's a whole topic I have a whole master session on. That's just due diligence. You communicate with the property manager and you make sure they bought into your business plan and all the numbers in your underwriting before you make an offer. Not after you take over. It's well before you make an offer, because they'll tweak it. They'll tweak it and say, you can get a little more on this, but you can't really push this. This doesn't work in this demographic. This could work, right? So it's things like that. So make sure it's a property management company with local knowledge of that market, and they've currently managed properties in that market. They're not coming in new and giving you a great deal. Oh, we'll just charge you a really low fees. Let us come in. Let us break through into the Dallas market. No, thank you. I want somebody who's already here, has the experience. I'll pay them a little more so they execute my business plan. So don't quibble on that last 0.5% and 1% with them. Pay them well, and they'll execute your plan better than you could have expected. And they'll find more cool ways to increase your other income or your rent without you asking for it.
Great point. Okay, Nico. Sandhya, how can people reach out to you?
I just put in my email address in there, multifamily for you, where the 4 is number 4 and it's YOU. Multifamily. So invest at multifamilyforyou.com. So it's in the chat box, which you said you would email all the attendees. So it's an easy way to get a hold of me. And certainly you can ask Joseph or Christine. They're all connected to me on LinkedIn and Facebook, and Trevor too. And you can definitely get a hold of me that way. Who else? Bunny is connected to me. I'm like, Manish, I think is connected in somewhere, either Facebook or LinkedIn. So I'm easy to find.
Awesome.
Great.
And if anyone wants to do anything in Dallas, find me.
Congratulations also, Sandy, on that awesome deal that you're going to sell soon. And David, you too. That was a really, really nice presentation. We got a little bit of everything. And, Christine put in the chat, we should bring you back on for her property management. We might have to. I mean, you're a wealth of knowledge and you're very well spoken, and it was really easy to listen to you and engaging. I was excited the whole time. So thank you so much.
Awesome. Glad to help.
I was really enjoying that. I was really enjoying it, Sandhya.
Oh, fantastic.
Yeah, there's not much that you can't grab some from Sandhya. She's always wanting to help. She takes my calls whenever I have questions. So she's really great.
Yeah, I mean, it's an abundance mentality, right? If I help you today, 3 years from now, I may need your help on something. You may be the one to teach me, listen, this is how you hire and employ VAs, right? And I need help with that. Because I'm such a control freak, I try to do everything myself. It's too much for me. So, or maybe you're the best at, I don't know, this Loom videos, or I don't know, Canva. I'm still trying to get good at Canva. There's something you can help me with, right?
Nico is the Canva expert.
Oh, really? You should do that with, you should offer that along with your wood services.
Yeah, I could do a webinar on how to use Canva or something. I think they have them on YouTube. Probably.
Yeah, it's helpful, right? I mean,
hanging out with you is better.
I know enough to be dangerous with it in terms of a PowerPoint level, but it's not as much as, okay, I want to do this. I can do this with one click in PowerPoint. How do I do this in Canva? Like I'll be staring at it. It'll take me like 15 minutes to figure out something. That's fairly simple. So I'm making myself a couple of templates so that all I do is plug and play into it differently each time.
Mm-hmm.
There's always some ways that we can help each other. So just keep growing that network.
Awesome. Thank you. Hey guys, if you want to reach out to Sandhya, I'm going to be sending a follow-up email within the coming days, and we'll let you know who's going to be on our next meetup. Joseph, you have something to announce about the day of our next meetup?
Yeah, our next meetup would not be falling on Wednesday due to a scheduled conflict with the guest. We'll be doing it on Thursday, which is July 15th, I believe. Is that right, Nico?
I think so. And,
okay, so
but
we're going to be sending out flyers again.
Awesome.
Thank you guys so much. We love you. We love the support. We're so happy to see you tonight, and have a great night.
Thank you, guys.
Night,
Thanks, guys.
Thank you, everybody.
Thanks, everybody.
Thank you, Sandy.